Cramer. Welcome to Mad Money. Welcome to Cramer, my friends. Hey, look, I'm just trying to make you a little bit of money here. My job is not just to entertain, but to put it in context. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. Performance is not in the eye of the beholder. And it's pretty easy to see that some formerly unstoppable stocks have momentarily lost some of their mojo. So on a day where the Dow soared 646 points, S&P advanced 0.21%, but the NASDAQ, where much of tech dwells, declined 0.26%, let's take a hard look at what should be done with beloved stocks that have been stalled. Stocks like Apple, Meta, and Tesla, all of which are up about 10% for the year. Let's start with what the heck is happening with the actual stock market. Today, for example, was a very logical day. Yesterday, the Fed cuts rates. Today, money managers rotated into stocks that will benefit from rate cuts. Makes sense, right? Rational. Even if they had to sell other things to raise money. Things like tech. Sell, sell, sell. First, lower rates spur consumer spending, so naturally the conspicuous consumer stocks are up nicely, starting with the totally discretionary cruise lines. Does that mean more people necessarily called Norwegian Cruise today to book a cruise? No. But if they were thinking of booking a cruise on credit, that just got cheaper, and a lot of what happens with stocks is theoretically based. Hard for you at home, trust me. Second, lower rates spur home building and home buying, and they spur home improvement, which can be financed by a home equity loan. There's a second-day business after a rate cut, so predictably Home Depot was really on the move again, even as I'm sure nothing extraordinary is going to happen there with a quarter-point cut. Still, we own it for the charitable trust. I'm going to talk about it in tomorrow's club meeting, but long story short, I think the despot works here, even if ICE, the immigration police, keep prowling their parking lots looking for people to deport, and that has hurt the stock. I know Home Depot's been doing poorly. Okay, I totally get that. What matters is management just told us that they'd do better if rates came down, and then rates came down. Don't outthink it. Trust them. I do. More broadly, retailers work when the Fed cuts. Always have, always will. Here I'm thinking of companies like TJX, which underperformed today, Walmart, even Target, which could roar if it can demonstrate any sort of turnaround. Depot kills two birds with one stone. The dollar stores, if they have good numbers, will get higher price earnings multiples. Those are really flying. Industrials always work in response to a rate cut because every hedge fund has been schooled to believe that these stocks go higher when the economy improves. We saw that yesterday with many of the industrials. And again today, second day. What I saw go up, I saw 3M go up, DuPont and Dover. The latter two in the charitable trust, which you can follow along by joining the CNBC Investing Club and get in on tomorrow's strategy session / club meeting. These kinds of stocks can all work for a couple more days. They have the wind at their back now. I love the transports, which are clearly breaking out here. I mentioned JB Hunt yesterday. It just started. It's going higher. Transports tend to run at least 5 days after a Fed rate cut. Not too late here. I, by the way, reiterate that this could be the breakout quarter for Federal Express, FedEx. Not too late for the companies that make aircraft or aircraft parts either. Check them out. For ages, banks have been valued on their net interest income, meaning how much they make on the difference between what they pay for your deposits and what they charge you for your loans. Now you have to switch direction and think which banks will lend more, as there's going to be plenty of demand. And that's a much better way to own a bank stock. That's why I like Wells Fargo, now that its asset cap has been lifted, and Capital One, because it bought Discover and is about to rival the big other credit card companies. They're up on a spike, both of them. Maybe you got to wait a bit, but I got to tell you something. You want to own them now, especially, I'll tell you, if JP Morgan were back where it was the other day. Remember I said to buy the stock because they had that meeting and sent the stock down? The stock went down to 300. It's at 317. I mean, enough already. Finally, because we have a president who thinks that rates are still way too high, and he'll appoint Jay Powell's replacement, who takes over next May. We don't even need to play the guessing game about how many more cuts we're going to get, although people constantly do it, and it does drive me crazy because it makes money. I say go to Kalshi. What matters is that the lower rates go, the more people will seek income from higher yielding stocks because the bond market just won't be as competitive. I spend a great deal of time on how to make money in any market discussing these kinds of stocks. But the best ones right now are the nat gas pipeline operators. They're all in the book, almost all of which have higher yielding. They're much higher yielding than treasuries. Now let's get back to those three formerly magnificent stocks that only rallied about 10% this year, Apple, Meta, and Tesla. Apple's not really impacted by lower rates. It has an immense cash position. It'll probably earn less on its cash. It's considered an AI loser, even though I think their installed base of over 2.3 billion devices and 1.5 billion users means one of these big chatbots will pay them a fortune to be the default platform, just like Google did with search. The long knives are always out for Apple, but if we all think that the hyperscalers are spending too much money on data centers, a continual big theme today about Oracle, then how the heck can we chide Apple for not doing much at all of spending on data centers? If OpenAI were to pay Apple $25 billion a year to be its default AI choice, it might be the greatest free rider case in history. If Gemini were to do it today, with today's Alphabet stock already red hot, that would go up another 50 points. All that said, Apple simply is not a beneficiary of lower rates. And when you're within a day of a rate cut, it's not the kind of stock money managers have any interest in. Apple's a momentary yawner and an underperformer as people sell Apple to move into these industrials and these banks, the other stocks I talk about, like maybe the retailers. That's just what's happened. It's happened no matter what. There's no way to relate Meta to rates either. It simply doesn't matter to the company. The stock is listless because it's become a one-day story the day it reports. I could argue that a Fed cut actually hurts Meta because it calls attention away from what might be happening at the company, which is very quiet but very good. I think the world of this company, and we hear that they're raising prices for their AI products. They should. They're too cheap, but it doesn't matter unless Mark Zuckerberg comes on to tell the story right here. Finally, Tesla's transitioning from auto company to tech company, from a company that's getting its head handed to it in sales to a company that's a nascent leader in robots and self-driving cars and in energy storage. The auto business benefits from a rate cut, but Tesla no longer trades like an auto stock. Everything else is totally unrelated to the Fed. It doesn't work. No wind at the back of any of these. Worse, when you get bad news from a big company like today, a tech company like Oracle, Oracle obviously seems to be promising more data center construction than its balance sheet can handle. If fewer data centers are built, that's bad for NVIDIA and the entire cohort. There's nothing from the Fed that helps any of these stories. And right now, money managers only want rate cut beneficiaries and nothing else. So everything trades down in tech. Well, listen to me. I wish that there were more to it than this. I wish I could tell you that there was something good happening with the winners or something bad happening with the losers, but it isn't. It just happens to be the stock market. Bottom line, you're ultimately just looking at fund flows. The more trading-oriented hedge funds are doing what I just described. How do I know this? I plead guilty. I was one for 14 years, and I did this exactly. Periodically, though, you know what I did? I get fed up with what everyone was doing, and I try to deviate, drifting from the hedge fund playbook. The bottom line, you know what happened? I got pancaked pretty much every time. It doesn't work when you freelance, when you want to be a pirate, when you want to listen to the beat of a different drummer. Hedge funds are like pack animals. When they move at once, like they did today, it's very costly to try to go against them and buy a lot of tech. I know. I have the tire tracks on my back to prove it. Robert in New York. Robert.
Jim, how are you? And I want to wish you a Merry Christmas, Happy Holidays to you and Lisa and the gang. I'm really, you've done phenomenal things for us this year.
Thank you, Robert. Thank you so much.
You better buy you a good gift, Jim. That's all I can say.
I don't know. Well, let's see. Let's hope she does. That's all I can say. Thank you.
Well, Jim, let me tell you something. You've made me so much money in a stock we're not talking about tonight, Caterpillar. You crushed it for me, and I want to thank you on that.
Thank you.
$300 a share. April 5th was when you were on the show, and you said, don't sell the stock at $238. And I want to
But remember, that was because Jim Appleby was the CEO back then. We had just gone to a Cowboys game together. He wasn't really a Cowboy fan, just so you know, but he did the right thing. And I just felt like, you know what, this guy, he doesn't talk about the stock. He just talks about how he was so excited about all the things at the company, and boom. It was a great thing. It was a great thing.
Thank you for doing it for me, Jim.
All right, what's up next? Let's do some more.
Yep. This next company reported fourth quarter results of 4.63% versus the 4.38 consensus estimate. Now, this earnings beat represented a 5.8% surprise, making this the sixth consecutive quarter that exceeded analysts' expectations, Jimbo. And analysts remain moderately bullish on this, and so do I, because you've got a great management team, Doug Yearley, Toll Brothers.
Oh, you're so right. Look, that's exactly what you buy here. I think Toll is doing phenomenally. Look, the only thing that was bad was that he said, look, if rates don't come down, we're not going to have good numbers. Well, guess what? Rates are coming down. I totally agree with Robert. Great call. Let's go to Sam in Pennsylvania. Sam.
Jim, I got an interesting one for you. Looking at the Kalshi spread, it looks like the market is pricing in a 75% chance that the tariffs get struck down. So I'm looking at Old Dominion, and I'm looking at their less than truckload freight business, and I think that this could be an interesting stock to play. The potential for tariffs coming down and their freight volumes increasing, especially.
I agree with you. I agree with you. I do. Now, just so you know, I like Old Dominion. I really, really, really like JB Hunt. But my favorite is Federal Express, FedEx. Darn. All right, look, it's hard to go against the grain with a move like we had today, and sometimes the best thing to do is just follow where the money is flowing, and that's what I'm telling you is happening. On Mad Money tonight, is it time to call a comeback for the consumer? I'm taking a look at the stocks tied to the travel industry to see if the recent moves higher have staying power in this market. Then for investors looking for a pure play in the ice cream space, look no further than this new company, Magnum Ice Cream. Started trading earlier this weekend. No one's paying attention. I'm going to give you the inside scoop to see if this company should be on your buy list. And shares of lumber producer Weyerhaeuser have been on the chopping block this year. Today's investor day was really good, but it can be the catalyst to turn around the stock. I'm finding out more from the CEO, so stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Earlier this year, it looked like the cash-strapped consumer might be giving up on travel. But something really changed a few weeks ago, as these consumer travel plays have been making a powerful comeback. So what is it that resuscitated these stocks? And more important, can they keep running? Buy! Okay, first, although we got a quarter-point rate cut from the Fed yesterday, for much of November, it looked like the rate cut was off the table. We kept hearing the Fed officials talk about persistent inflation, signaling they were inclined to skip a rate cut in the December meeting. But in late November, that changed. In fact, you can pretty much trace the bottom to the Friday before Thanksgiving, when the president of the New York Fed said he thought there was room to cut rates, citing weakness in the labor market. Went from expecting no more Fed help to believing that the Fed was still practically on our side overnight, which breathed new life into all kinds of consumer stocks, including the travel plays. But it also reminds me not to play the Fed guessing game that so many do. Too many people get it wrong. It makes it just not worth your time. Now, around that same time, we got a bunch of strong earnings reports from some of the nation's strongest retailers. You don't see good numbers from Walmart and Abercrombie and Kohl's and The Gap when the consumer's really struggling. Finally, there was the crucial Thanksgiving weekend shopping period from Black Friday through Cyber Monday. Without getting too in the weeds, we saw pretty much some solid sales growth, as we know from tonight when we take a look at that Lululemon number. Now, this is important because it cuts against the narrative from most consumer confidence measures, which have been very weak. Now, I've warned you about this before. What consumers say in polls about how they're feeling is often very different from what consumers actually do with their money. People are very clear that they're not feeling too great about their finances, but they're still spending like normal, at least when it comes to holiday shopping, and I bet the same goes for travel. So what exactly is working in the consumer travel space? Why don't we start with the airlines, which have really roared from their November lows. The JETS, JETS ETF, the best proxy for the group, is up nearly 20% from its lows set 3 weeks ago. 20%. Delta, United, American Air, they're up more than 20% over the same period. Some of the lower cost names like Southwest Air and Alaska Air are up even more than that, with gains close to 40% from the November lows. I spoke with Bob Jordan, the CEO of Southwest, on Squawk on the Street yesterday. He sounded pretty darn enthusiastic about his company's prospects now that they're working hand in hand with the very smart activist investors at Elliott Management. In a great note published on Sunday, Melius research analyst Connor Cunningham pointed out that investors have been on the sidelines with the airline stocks, waiting to see what kind of impact the government shutdown would have on them. And what we've seen is that the hit was much smaller than expected, with holiday travel demand also looking real good. For example, Delta, I regard that as kind of the biggest and best of the airlines. They published an 8K last week where they estimated they'd taken a $200 million hit to pre-tax profit from the government shutdown. At the same time, they said, I'm going to quote here, demand remains healthy for the December quarter and trends are strong for early 2026, end quote. That sounds good to me. not just the airlines. In lodging, we've seen a nice move from Marriott International, the world's largest hotel company, up about 14% since the end of October, in part because the company reported a strong quarter in early November. Marriott's CFO also gave a presentation at an industry conference on November 21st, where he offered an upbeat outlook and said that, quote, leisure has completely and utterly held up exactly where we thought it would be, end quote. Wow, that's throughout the year. He added that the government shutdown created some noise for business travel, but he didn't seem all that worried about it. Love this stock class by itself, and people were so worried about the shutdowns. It didn't play a role. Also, while Airbnb has been a very frustrating stock to me since it came public 5 years ago, stock's now up more than 15% from its lows just 3 weeks ago. In theory, Airbnb makes sense for consumers traveling on a budget, but I've been burned so many times recommending this stock to you, and I still like it. But I don't feel like sticking my neck out at this very moment. I'd much rather go with the online travel and agencies like Expedia and Booking Holdings, the old Priceline. Bookings rallied more than 15% gain from its low November low. Expedia's up almost 35% from where it bottomed in early November. Of the two, Expedia had the better third quarter. You know what? I still prefer Booking Holdings because it is the superior operator. That said, Expedia is the cheaper stock, trading at just over 15 times extra earnings. That's way too cheap, versus roughly 20 times earnings for Booking. Plus, both of them should do better if I'm right about the consumers a lot more resilient than anyone thought a month ago. Finally, as I looked over the S&P 500's top gainers today, I noticed that 3 of the top 5 gains came from major cruise line companies. I thought this strange. Royal Caribbean, Norwegian Cruise Lines, Carnival, all up about 6%. But that, again, is part of what you buy after a Fed cut if you think the consumer's better than you think. Let's also not forget about Viking Holdings, the river cruise company that's not included in the S&P 500. That is my favorite. Viking's held up much better than the 3 majors this year because it's more focused on older, wealthier travelers. The whole group's been roaring for the past couple of weeks, in part because everyone recognized that the Fed is still our friend and the shutdown didn't really matter. Well, I'm happy to see all these travel stocks roaring. You have to be cognizant that if you buy them up here, you are chasing them a little bit. But, I'm also wary about the fact that Wall Street's attitude toward anything connected to the consumer can apparently change on the dime like it did 3 weeks ago. The last change was positive. Who knows what's going to happen next? All that said, I do think most of these travel rallies can continue, given that many of these names are still well off their highs and trading at very reasonable price earnings multiples, and that's what people do in this kind of market. Here's the bottom line. We need to stay close to the consumer, watching what they're doing, rather than indicators that only follow what the people say they're doing, to make sure that there's no clear sign that things are deteriorating right now. We don't want to. We have to stay so close it's hard to own these stocks. I think the consumer travel trade, though, can keep working. As long as the Fed remains our friend, I bet these stocks continue to go higher. And there's a residue here from the pandemic. It taught us something. We're long on money, but we're short on time. That Money is back after the break.
Coming up, ice cream, you scream, we all scream for ice cream. But should you treat the dessert as an investment opportunity? Cramer's got the scoop on the Magnum Ice Cream Company. Next.
Earlier this week, Unilever spun off its ice cream business as the Magnum Ice Cream Company, MICC for you home gamers, creating the first pure-play ice cream stock that I can recall. Unilever announced this nearly 2 years ago, but to be honest, I really didn't pay a lot of attention to it. So it took me by surprise when I came into work yesterday to see this multi-story tall banner of ice cream outside the New York Stock Exchange with free samples flowing on the floor. Klondike bars for all. I'm still mad at myself I didn't grab one. But I did ask myself, hey, maybe this thing's worth owning. Unilever didn't seem to want it, but maybe it'll be worth more as an independent company. I'm optimistic. I'm going to tell you why. First, the Magnum Ice Cream Company is by far the largest player in the industry. They own 4 of the world's 5 largest ice cream brands, Walls, Magnum, Ben & Jerry's, and Cornetto. Overall, they sell more than 100 brands across 80 countries, including my old fave, Breyers, from when you grew up in Philadelphia, that's what you have. Good Humor. I was never the Good Humor man, though. Klondike, along with Talenti Gelato, which is my favorite gelato, not that you care. The Italians will tell you this is not ice cream. Then Yasso frozen Greek yogurt bars. I don't like that. But that doesn't mean anything. Put it all together, and the Magnum Ice Cream Company has 21% global market share. The next competitor, close competitor, is a British company called Froneri, and that, I've had their stuff, has just 11%. Nobody else has even more than 2%. Magnum's the market leader in every developed country except India and China, where they're number 2. Now, despite the rise of these GLP-1 weight loss drugs that have been hounding the packaged food industry, the ice cream business has been doing pretty well. As for Magnum itself, the company was struggling for a while under Unilever. They saw a 6.5% decline in volume in 2023, which is one reason their parent company was so happy to do the spinoff. But once Unilever decided to separate the businesses, well, the ice cream division started buckling down, enacting a plan to achieve €500 million in productivity savings and reinvesting those in ice cream, something they couldn't really do as part of a gigantic conglomerate, could they? Here's how CEO Peter Takulva put it when he came on Squawk on the Street yesterday morning.
Unilever needed to focus on its category, and we needed real focus on ice cream. I now have 19,000 people who go to bed thinking about ice cream, who get up thinking about ice cream, and we're able to invest behind the growth opportunity. And we don't have to balance that between all kinds of different categories in Unilever, but the focus is on ice cream.
Anyway, of course, he's wrong. There's 19,001 people who get up and go to bed sleeping with ice cream, and that's me, but there's nothing I can really do about that because I don't work for him. But this company has already started turning around with organic volume growth going positive again, up 1.1%, while organic sales are up 2.8%. Remember, they were down. The company's gross margin improved for the first time in years. I'm thinking this thing might be a gem. In the first half of 2025, the momentum continued. Magnum's organic sales growth accelerated up 5.8%. Market share ticked higher. Margins dipped a bit, leading to roughly flat profits year over year. It seemed like the company's trending in the right direction, though. Everybody in the snack food space lives in fear of Ozempic, yet Magnum Ice Cream is putting up solid sales and volume growth, so clearly they're not being hurt too badly. The company has plans to boost its profitability through modest price increases, and they're targeting organic sales growth in the 3 to 5% growth range. I mean, that's, to me, is pretty good. But maybe the most important part of what Magnum's had to say is about the GLP-1. See, when you ask most packaged food CEOs about these weight loss drugs, they're incredibly cagey about what the impact's been, even if they may even deny if there's any impact at all. But that's their problem. But when Peter Takulva came on Squawk on the Street yesterday, he was incredibly straightforward. First of all, Magnum's not in the dark. They had good data on all of this, including from U.S. retailers that sell both GLP-1s and ice cream. What they found is that for every 12% market penetration for the GLP-1s, which is about double what we have currently in America, the ice cream market takes a 0.5% hit to volume growth. Now, that's real. It's empirical. It's not great, but it's, I think, a lot better than people thought. His theory: people don't tend to mindlessly gorge on ice cream the same way they gorge on potato chips or on Ben & Jerry's, okay? No, this is a cookie dough. I had this just the other day. It's really good. Plus, in terms of calories, ice cream is much better than chocolate or chips, and it's a great source of calcium and protein. So at the end of the day, Magnum's simply not suffering very much from the rise of the GLPs. It's kind of better than people thought. The other issue that's making headlines here is that the founders of Ben & Jerry's have been making a lot of noise, criticizing first Unilever, now the Magnum Ice Cream Company, for not promoting the brand's original values. This, to me, it's unimportant. Those guys sold their brand to Unilever 25 years ago. When he was asked about the issue yesterday, Magnum CEO dismissed the issue, saying that the founders are unhappy, want the brand back. Obviously, it's not going to happen. Ben & Jerry's is making a fortune for Magnum anyway. Now, I've got to tell you, that issue keeps coming up, and it just doesn't mean much to the stock price. Finally, let's talk valuation. After a solid start this week, including a 4% gain today, Magnum currently sits at $15 and change. A couple of analysts have rolled out coverage on this stock this week, so we have some early consensus estimates here. Magnum's expected to generate $1.26 of earnings per share this year, though that's expected to fall slightly to $1.23 next year as the company makes some investments in its first year as an independent entity. I'm fine with that. Either way, you're talking about a stock that's selling for roughly 12 to 13 times earnings. Now, let's think about this. This is not bad. See, Hershey, The leading chocolate and candy outfit sells for 27 times next year's numbers. Cookie champion Mondelez International is closer to Magnum, but still trades at a premium, selling for 17 times next year's numbers. Nestle, good compass, a European food company with big chocolate and even ice cream business, is in the same range at just under 18 times next year's numbers. That said, these companies are expected to grow earnings next year, whereas I just said it, Magnum's currently expected to take a small earnings hit in 2026. Still, the stock's trading at a pretty sizable discount to its peers. So if you want to bet on the ice cream business, you got my blessing to do some buying right here. I love an IPO that comes out and doesn't shoot up to the sky and then everybody gets hurt. I like one that's not on anybody's radar screen. That's this deal. Here's the bottom line. We finally, by the grace of God, or at least the grace of Unilever, have a pure play ice cream stock now that the Magnum Ice Cream Company has been spun off and started trading independently. And after taking a closer look at the story, I have to say this one's pretty sweet. I'm sorry, I had to go there. Couldn't resist. And may I also say, apropos of how to make money in any market, my book, if you want to give a share of to a kid of a stock, and you want them to follow it, I'm thinking it's this one. I used to think it's Disney. This one has more upside. Let's go to Bill, North Carolina. Bill.
Morning, Jim. Merry Christmas.
Bill, what's up?
Hey, I bought Shake Shack back when they said it's the best thing since sliced bread. They got tons of cash. They're building stores. Bought it $123 a share. I'm losing my shirt. Should I hold or sell and go to the poorhouse?
Okay. This is such a great question. Now, you have to understand that Rob Lynch is doing a remarkable job, and he's a great CEO. Here's the problem. This stock is trading with the price of beef, and cattle went up and up and up. I think the president's going to try to bring cattle down. I think that means you buy Shake Shack. I think it doesn't matter where stocks come from. It matters where it's going to. I would never bet against Rob Lynch. I think that you buy Shake Shack at $79 a share. Now, if you want to bet on the future of the ice cream business, which I have to tell you after doing the research, I do. This is the best of the bunch, and you can do some buying right here of Magnum. Now, there's much more Mad Money ahead, including my sit-down with Weyerhaeuser. The lumber producer stock has been going down for most of 2025, but is it too late to yell timber? My favorite song. I'm getting the latest from the company's top brass at its investor. Then Cisco's finally round-tripped its dot-com era highs. I'm going to break down why the stock looks more compelling now than ever. And oil calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. Earlier today, we got an update from Weyerhaeuser. It's the largest private owner of timberlands in North America. At its investor meeting, where management laid out an optimistic long-term forecast for 2030. Unfortunately, Weyerhaeuser's largest business is wood products. And somehow it's still joined at the hip with the American housing market. And that has not been a great place to be in 2025. I tell you that a lot. And that's why the stock's down nearly 18% for the year. But with the Fed putting through a 25 basis point rate cut yesterday, there's a real chance mortgage rates might start coming down, which would really make the stock go higher. So let's take a close look with Devin Stockfish, the president and CEO of Weyerhaeuser, to learn more. Mr. Stockfish, welcome back to Mad Money.
Great to see you, Jim. Thanks for having me.
So I want to brainstorm with you. I see all the things you're doing. You have what we call a deck in this business, page after page of really original thinking. I mean, frankly, kind of outside the box, whether it be AI, whether it be robotics, whether it be all the different things that you're doing for the environment. And yet somehow it seems to still come down to the price of lumber and whether there's a big surge in housing. How can you make it so it's not about those after all the things you've tried?
Yeah, Jim. I mean, so really excited earlier today to lay out our multi-year growth strategy. It comprises initiatives really cutting across all of the businesses. Many of those are not going to be directly tied to the housing market. And so that's an opportunity for us to diversify our revenue stream to some degree. You know, the housing market, it's been stuck in second gear here recently. Repair and remodel has been a little soft. And so that's been a headwind for product pricing. But that being said, we still have a lot of optimism over the long term. We know we're significantly underbuilt in the U.S. from a housing standpoint. We've got to build millions of homes. That's going to be a strong tailwind for our business ultimately.
But at the same time, I don't mean to slag the other guys, and I really don't mean to. That's important, because I've looked at all the companies. But your so-called comps, the other companies, aren't doing nearly as many interesting things as you are. But their trajectory of the stock is similar. It's almost as if it's just a big ETF, and you can't get out of it, Devin.
Yeah, well, I think, again, it goes back a lot of it to just the macro overhang from what's going on with housing. But ultimately, you know, we are really doing things that are out in front of the rest of the industry.
Totally.
When you look at the work we're doing in climate solutions, the industry-leading margins, all of the work we're doing with our new strategic land solutions business, we're really in a class of our own at this point, and we've got to go out and execute. We've got to deliver on this growth plan. But ultimately, I think the value's there, and we'll see that reflected in the stock price.
Okay, I mean, one of the things that you're doing, well, you've done so many things for the environment, and we have a president, for better or worse, or like him or hate him, he does not share the orientation that you have brought, which I think is frankly just physics and chemistry, these were things you learned in physics and chemistry when you took them, and you're not getting much credit for some of the terrific things you're doing for the environment.
Yeah. Well, I mean, I think there's a benefit to a lot of the things we do, just the nature of forestry, making things out of wood. There's an inherent climate benefit to that. Now, I will say, the administration has been very supportive of our industry, the lumber industry.
I mean, about tariffs, absolutely.
But just in general, supporting manufacturing, rural communities,
right, that's true.
Wood products, the lumber space. So we have had good support for the administration. But more broadly, our business has always been run sustainably. Back 100 years, this is a core to who we are. And a lot of the new climate solutions businesses that we're bringing to market really reflect that.
Right now, you have $16 billion market cap. You have some debt, so you take it to the 20s. We have a country of very, very rich people. I'm not a country, I understand that a lot of people who aren't, but has a rich person ever come to you and say, you know what, I will pay you $8 billion for your Northwest properties?
That has not happened to date. I think people maybe underappreciate the magnitude of how challenging it is to run a portfolio of that magnitude.
Indeed.
That being said, they're always welcome to buy into the stock. That's a very easy way to get into the space.
With your balance sheet, could you double your buyback if you wanted to?
We could, and we have. I mean, when you look back over the last several years, since we rolled out our 2021 Investor Day targets, which we announced we hit those earlier today, we've closed out $1 billion share repurchase program earlier this year. We put another $1 billion program in place. And so that's clearly an area where we think that creates value and something that we're going to continue to do.
When I look at what the home builders own, their acreage, and I look at your acreage, you represent a substantial discount to what they have in their land bank, so to speak. Do people understand that?
They don't. And that's a great point, Jim. And that's one of the opportunities that we have and one of the growth initiatives that we laid out earlier today. There's an opportunity for us to lean into that real estate development piece with a little more heft and really unlock some of that value and take it back to the Weyerhaeuser shareholders.
Now, I covered ASIC very closely. A friend of mine ran the company.
Yep.
And it was very clear that there are characteristics that are better than wood when it comes to, say, if you have a beach house, so to speak. But wood is kind of irreplaceable in a lot of ways, both inside and outside. Did any of these kind of composites with tires, with plastic, do they represent a threat to Weyerhaeuser?
They don't. In fact, I would say there's an opportunity for us to expand the use of wood fiber. And one of the things we rolled out earlier today with the new biocarbon business is the ability to take wood from mill residuals, pulp wood that ordinarily would have gone into pulp and paper, run that through a proprietary process, and make a drop-in replacement for metallurgical coal. So that's an example of looking for opportunities to leverage our wood fiber to drive revenue.
I was thinking, because I wanted to come down with you and brainstorm, because you're such a thoughtful person about not just about wood and not just about land, but the environment and the right thing to be as a steward of our earth. You've come up with maybe, I'd say, 10 incredibly important initiatives. But they don't seem to matter. Will they matter by 2030?
They will, Jim. And I think part of that is when we started our climate solutions business back in 2021, we set a goal to hit $100 million of EBITDA by the end of this year. We've closed that off. We've hit that target. And now we're ready to really start to scale this business. And so for 2030, we've increased that target to $250 million. And we think there's opportunity to continue to grow that over time. So as that picks up momentum and becomes larger and more scaled, I think we'll get to see that more reflected in the stock price and the valuation.
Well, if you had to put all the different things that you've come up with, and you're really an inventive person, together, don't you think that they alone exceed the value of the market cap?
Yeah, there's no question. At this point, we're undervalued. You can look at the value of our timberlands, the value of our wood products business, all the things we're doing with climate solutions and real estate. No question. And I think part of that is, we need a catalyst with some more housing momentum, repair and remodel, which I do think will come back at some point in the not too distant future. That's a little bit of a headwind, but ultimately the market will realize and understand the value.
Well, I know that the company is radically undervalued because of maybe it's because of tariffs, maybe because of housing, but it has to be valued. It will out, so to speak. The things that you're doing will out. I have great confidence in that.
Yeah, I appreciate that, Jim, and we agree. And like I said, we're really excited about the growth initiatives that we laid out earlier today. As these really start to gain momentum, which I will just say, the vast majority of these already underway.
Right.
Those that aren't will be shortly. A lot of control, so we have a lot of confidence in our ability to get
I urge people to look at this deck. If you just to be thoughtful about what can be done with the earth, with trees, with wood, but also with your dollars. That's Devin Stockfish, President and CEO of Weyerhaeuser, WY. I'm frustrated because I am so thrilled about all the things you do, and I hope you get credit for it one day.
All right. Thanks a lot, Jim.
Absolutely.
Appreciate the support.
Mad Money's back after the break.
Coming up, Cramer takes your calls, and the sky's the limit. It's a fast-fire lightning round. Next.
It is time. It's time for the light round. Quick minutes from Rapid Calls. I'm CNBC stock declared above and buy, sell, still just being recalled every time. My staff prepares the graphics of the volume. Plain and sound. And then the lightning round is over. Are you ready, Steve? Daddy, time for the light round. Let's start with Steve in New York. Steve.
Booyah, Jim. Huge fan. Squawking the street. You got a heart of a lion, Jimmy.
Thank you. Thank you, buddy.
Quick question, boss. What's your 1 year projected performance on a micro strategy? MSCR.
Well, look, let's leave it like this. They call it now strategy, but I like Bitcoin, and I think you should just own Bitcoin. I don't want any derivative of Bitcoin. I just want Bitcoin. Let's go to Roman in Maryland. Roman.
To you, Jim.
Roman.
I want to give a shout out to Mr. Marks. I'm doing good. And the stock I'm asking about is Bank of Nova Scotia, ticker symbol BNS.
I've liked BNS from the first time I was in the Caribbean. I said, boy, these guys just own the Caribbean. It's a very good company. It yields 4%. Let's go to Mark in Wisconsin. Mark.
Hey, Jim. I'm a three-peat caller. Love your book.
Thank you.
The only company with direct-to-cell phone, broadband, low Earth orbit satellite connectivity will launch their 6.5-ton Bluebird satellite on Monday. The stock is already in orbit. They have agreements with Verizon and Vodafone. What is your latest take on AST Space Mobile, Jim?
The space stocks are plain and simple specs. That doesn't mean you shouldn't buy it. As I say in my book, you should buy one. This may be the one to buy. I'm not against it, but you have to understand that if it goes down, it's speculative. You could lose a lot of money. Let's go to Dave in New Jersey. Dave.
Jim, thanks to what I've learned from your show, I've been able to pay for my son's education at St. Joseph's University in Philly. My son's name is Matthew. He's an Eagles fan and a big fan of yours. If you could give him a shout out, I'd appreciate it.
Go Hawks.
And please
Absolutely, man.
Buy, sell, or hold Dexcom. Thank you.
You know, it's too rich a stock, and I do think the GOP-1s are going to have such a dramatic effect on their market. I don't want to own the stock. Now, it will have a dramatic effect on the psychology of the people who want to buy the stock. That's a better way to put it. Let's go to Andy in New York. Andy.
Hey, Jim. How's it going, man?
Not bad, Andy. How you doing?
Not too bad myself. I got a stock for you here. Hopefully I can get a booyah out of you for it. All right, it's ticker NRG.
You are going to get a booyah because I like the nuclear component there. I think it's a very well-run company. Let's go to Judith in Pennsylvania. Judith.
Hey there, Mr. Cramer. I'm a fellow Pennsylvanian, but I'm from the other side of the state.
The other side of the state is really kind of like Reading. Go ahead.
No, the
stops there.
Pittsburgh.
State stops there.
Okay.
No, I know.
But,
the state stops there. That's too far out. That's way too far. It's like exit 4,220 in the Pennsylvania Turnpike versus, say, the show Task, exit 360. That's me. How can I help you?
Yeah, probably. Okay. I was wondering what your thoughts are on the Latin Amazon Mercado Libre.
That is such a good company. I was an original investor in it, and I had to give up stock. Obviously, I'm not owning any stocks. That is a good one. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, could Cisco be the next company to seize on the AI revolution? Cramer takes a closer look at the web giant and whether investors are using the right approach. Next.
One of the more time-honored shibboleths in this business is that irony is somehow an investment strategy. It's not. Lots of smart people, or at least people who think they're smart, like to point out that stocks or index funds that, after wandering in the wilderness for ages, have finally broken out. For some, that's a celebration. For others, it's a klaxon to get out now. Take today's chatter about Cisco. The company still represents the backbone of pretty much all networking, and it legendarily led the dot-com movement 25 years ago. For a short time, Cisco was the world's largest company, valued at $555 billion. That's when the stock set its previous closing high of $80.06 per share, which turned out to be a top for the ages. It took Cisco 25 years to temporarily get back to the same price, although the level didn't hold today and it finished at $79 and change. By the way, its market capitalization is still nowhere near the peak. So what's the captivating irony here? Simple. After that top, the stock endured one of the most hellacious sell-offs of all time. Sell. Bottoming at $8.12 on October 8th of 2002. That's a 90% decline. Staggering. I don't know how you come back from that. Those who invest in irony see that peak back in 2000. They say, oh, here we go again. Except this time it's the data center boom, not the internet boom. Let me tell you how foolish that is. I spent a long time on how to make money in any market, my book right here, talking about the M, the key letter in the pricing model for stocks. The M being the shorthand for the multiple that the market pays for a company's earnings. That's how stocks are valued. At the top in 2000, Cisco's forward price earnings multiple was somewhere near over 130. That's ridiculously high for any market. That should have been a clarion call. Now, Cisco's valued at less than 19 times forward earnings now, literally less than a sixth of its peak valuation in the dot-com era. These days, it's viewed as a stable, growing tech company that helps clients manage their networks and keep them secure. That's a much more prosaic version of Cisco than what we were being pitched 25 years ago. I know it well because my hedge fund owned Cisco for years and made a killing in it. I even fatally suggested at one point that management should celebrate the money it had made for people not too long before the peak. Of course, Cisco turned out to have made you nothing if you stubbornly held on to it. We sold it, as well as almost all of our other stocks, in March 2000, shortly before the top. I was worried about a deluge of stock sales from a host of second-rate companies that didn't have any earnings, and the insiders were dumping like mad. Their selling brought down the whole dot-com edifice. This time, though, we got long Cisco for the charitable trust, precisely because of how cheap it is and how CEO Chuck Robbins has reinvented the company. We don't invest in irony for the trust. We invest in companies. And this company's at the heart of the AI revolution. Yet it doesn't get the respect or the price earnings multiple that its compadres do, despite accelerating product order growth and a rock-solid balance sheet. In the latest quarter, Cisco's earnings jumped 10% on an annual basis. Revenue increased 8%. These are good numbers, people, for a stock that trades at just 19 times earnings. I keep hearing that the AI revolution will end like the dot-com revolution in 2000, a disaster. It's true that there are plenty of fully valued companies now, but time and again they reported higher than expected earnings, and it turns out they only looked fully valued on estimates that were too low. So many turned out to be cheaper in retrospect, including Cisco, along with Meta, Alphabet, and of course NVIDIA. If you look at the winners this time around, they're incredibly well capitalized, except Oracle, which is struggling with a monster AI data center bet, and who knows what's going to happen there. If you're investing in irony, I think you should buy a book. The portable Dorothy Parker only cost 99 cents on Kindle. A whole lot of bang for your buck there. But when it comes to stocks, irony's just a loser, plain and simple. I like to say there's always a bull market somewhere. I promise I'll find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.